All right, everyone. Well, thanks for coming on. Again, 6:30 at night on a Wednesday night. So appreciate you guys spending some time with us this evening. This will probably end, if I had to guess, around 7:30. Unfortunately, I have to hop on another Zoom call at 7 o'clock, but I'm going to do that from my cell. So what might end up happening is I might disappear from 7 and I might reappear again at 7:30. If I don't reappear again, just feel free to get off, and Josh, you'll close out the segment tonight. So I appreciate you doing that as well. I didn't want to reschedule this. But anyway, so again, thanks for coming on. I know pretty much everybody here for a couple, except for a couple people. I'm Anthony Scandariato. I'm founder of this meetup group, Discovering Multifamily Investor Association. I also run the Discovering Multifamily podcast. I had Josh on as a guest a couple weeks ago on our show to talk about how to utilize your 401k, IRA. How exactly do you do that? What are the certain mechanisms? There's a lot of nuances to this, and Josh is an expert at it. So figured it would be a good topic for us to discuss because I know a lot of people reach out to me and ask how do I use the IRA to invest in deals, and I always try to forward them to experts. So Josh is definitely one of them. And Josh, thanks for coming on this. Really appreciate it. And I'll let you take the floor. So like I said, Josh will give an overview, his presentation, and then maybe around, depending upon how long your overview is, usually around 7, we'll open it up to questions, or 7:15, and then kind of go take it from there. But again, you might see me pop off. So I'll be in contact through the chat, worst case scenario. So again, appreciate your patience there, and let's get started. So Josh, want to give us your background and intro? And
yeah, sure. I'll jump into that. Actually, let me ask if I can share my screen real quick.
Oh,
made that permission. I just realized didn't have it.
Okay. Now I'm gonna make a host.
Okay.
There you go.
All right, so let's do that. Share the screen. Let's switch into the presentation. Cool. Hey, everyone. Thanks for having me, Anthony. Just kind of wanted to talk on a subject that I've found myself, somehow Anthony calls me an expert. I just gained a lot of experience in this in the last few years. So I've started to kind of build a company around this, and I'll talk about that. So I like to kind of start with just a rhetorical question. Where do you think the leading source of equity of wealth is for the average American? And it kind of surprises some people sometimes. It's, the first one is in their house. A lot of people have, a lot of equity in their house. And the second is actually in your retirement accounts. And so when I realized this, I really wanted to help others because I had some sort of, as I talk about, I have an experience of how to handle those. And when I realized that other people had an opportunity to, really to make use of their own types of retirement accounts.
When is it going to be? They don't know yet. Oh, okay. Not sure what you're doing.
Sorry, I just want to try to mute everybody.
Who's that? Josh, I think you have to mute them.
I know, yeah, I'm trying, but I actually don't see any users that aren't muted. Oh, there we go. Found that last one on the list. Okay, sorry. So let's go over how you can actually use your IRA or 401k to evaluate alternative asset classes. So the mission I had for my company is called Wall to Main, and the mission I had for it really came from a conversation I had with my dad about 3 years ago. He was turning 60 at the time, and we were kind of sitting down to plan his retirement and figure out where he was going to go over the next 5-10 years. It wasn't immediate, but we want to kind of, start to get a hold of where he was going to go. So, his 401k at the time was doing great, and it still is. He's invested in a broad basket of mutual funds and stocks, ETFs, really exposed to kind of the whole picture. And so everything's been going well, as we all know, at least until a few weeks ago. And then, things they're looking pretty good for him. But he's really concerned about, those investments and what's going to happen when he actually ends up retiring. A lot of people start wondering when the market, when they need to dip into their 401k, is it going to be there for them? He's a high income earner, he's a lawyer, and he was worried that when he retires, when he touches his 401k and he has to start leaning on that for income, that will the stock market continue to climb? Will it be there, or will it drop out from underneath him? Because ideally, nobody really wants to pull out from their retirement accounts when the chips are down. And so this is a reality for a lot of Americans. They wonder if the stock market is going to have their back when it comes time to retire. So I built Multifamily, which aims to help investors, diversify and de-risk their portfolio, especially their retirement accounts, to help build a better future. And so you might be wondering why someone as young as myself is actually talking about retirement accounts. I'm only 30 years old, but I've actually been doing it for about half my life now. I've been doing it since I was 16. At the behest of my mother and my grandfather, who were both CPAs, I opened up my first Roth IRA when I was 16 years old. I was a camp counselor that summer. I earned a couple $1,000, $2,000 or $3,000, and I decided I was going to start putting some money towards my future. And so I put about $1,200 away into a mutual fund. This was a good lesson for me because it taught me something that I still use to this day: invest in what you know. I was a teenager. I was obsessed with airplanes. I kind of still am, but I invested in a mutual fund that was aerospace and defense. That's what I knew at the time, and so it did fairly well. Over the next 10 years or so, and I continued to add into that account and to compound the growth of my overall Roth IRA, and that really showed me how impactful continuing to invest can be. And it was kind of the inspiration for really the next step I took into investing and moving into alternative asset classes, which we all know and love. So fast forward about 10 years after that, and both my mother and my grandfather, who I had mentioned, they actually passed away. And what that ended up doing was leaving me with the retirement plans of a baby boomer and a member of the greatest generation. And it was with my sisters as well. And it wasn't a life-changing amount of money, but it was enough that I needed to make sure I was going to be a good steward of everything that they worked for, everything that they had earned in their lifetime, and ensure that I wasn't going to just, put it all in the first shiny object I saw, the first property, didn't get involved in like a turnkey property that, didn't have a lot of upside, and pray that it worked. I needed to make sure I was going to educate myself. And what resulted was just a ton of learning. I went to every corner of the internet, of webinars, in-person presentations, books, everything, learning what I could about this. And so what I ended up finding actually was most of the presentations, most of the education that is derived in the retirement, the self-directed retirement space, is actually generated by custodians. And, custodians are out there, they're a business, they're trying to sell a product. And so the education is pretty good. They're telling you what you can and can't do with your account. So they get you excited about what your possibilities are, but they actually don't go down the full path of all of the options that are open to you. And they don't want to generate business for other people. So they really, they pitch a nice case for themselves. And in reality, they may not be for many investors the ultimate best opportunity. They're a good option, but they're maybe not the ultimate right choice. And so that's what I kind of learned as an investor, was where to take my account. And that's kind of what I do with Multifamily, is I educate and help others realize their full potential and where they can take their accounts. And then I help investors find those investments. So let's go over, the basics to start with. This is your chance to diversify. You might have already figured this out, but you can use your IRA or 401k to invest in virtually anything you like. We're not just talking real estate. You can do cryptocurrency, gold. I've heard of people buying, racehorses and doing a racehorsing operation that way. So lots of options. Basically, the only things you can invest in are collectibles like art, jewelry, or cars, life insurance, S corporations, shares in S corporations, If it's not one of those three things and you think it's a good investment, it's totally fair game. The IRS is down for it. They don't mind at all. So the thing is, most of our retirement accounts are at custodians like Schwab or Vanguard, these big, these big corporations, and their brokerages they're set up primarily for stocks, bonds, equities. And so they don't actually facilitate these non-stock and bond investments that we're interested in, investing. So you actually need to move it into a different custodian, and take control of it. And so the nice thing is you can do anything you want, but the problem is you actually have to have control over it beforehand. And what I mean by this is if it's with a current employer, if the account you're thinking of is with, like a 401k at a current employer, you need to be able to do what's called an in-service rollover. Now, unfortunately, most employers don't allow for an in-service rollover, but it's worth asking if this is your case. But if it's a 401k from a previous employer, it's not tied to that employer, you can totally take it away. If it's an IRA that you've started on your own or anything else, you can totally move it and take control of it yourself. And so that's the key to start everything. If you don't have control over it, unfortunately, you can't really self-direct at the time. You need to move employers to do so. So let's go over the rules of what we can and can't do with these accounts. So the main key thing here is that you cannot benefit from your retirement account, or your retirement account cannot actually benefit from you. You cannot aid the investments that your retirement account is making. And then in addition, you cannot personally benefit from the things that your retirement account is going to do. And so this means that there's no active participation. You can buy a house to flip if you'd like. It's an option, but you actually cannot, you can't go and swing a hammer. You can't sweep a broom. There's nothing you can do that's considered sweat equity, because you is impacting future use dollars. You're impacting your retirement dollars, and that's not allowed. And this includes any deals that you're a general partner on. I specialize in multifamily, and if I'm putting together a deal, I cannot actually invest in that deal myself with my retirement dollars because I'm in control of that deal and I'm working on it. So as a result, this means that all income must be from passive activities only. So that's kind of why I jumped into multifamily, because it really is for limited partners a purely passive investment. But because of all of this, I like to think of your retirement account like it's another person. So keep this strategy in mind. It's actually going to come back to help us out in a little bit here. So first, though, I want to talk about the people that you can and can't invest with. This is another key that you need to know before you get started. The concept here is called disqualified persons. And what that means is that this is anybody that you can't have any business between your retirement account and them, or their retirement account and you. And so we mentioned this before, a disqualified person cannot benefit from what your retirement account is doing, what they're investing in, the properties they hold. And then those people cannot actually help or aid the investments that your retirement account is making as well. So when it comes to the assets that you can buy, you could buy a rental property with your retirement account. That's totally allowed, but you can't let a disqualified person stay there. You can buy a short-term rental like an Airbnb, and you can't let a disqualified person stay there, even if you wanted them to stay for free, because they're benefiting, especially if it's for free, from the actions and the investments of your retirement account. And then there's all kinds of interactions here that you're just not allowed to do. There's really no business your retirement account has that can be done with a disqualified person. And this goes for, just like yourself, any deal that they're managing. And especially, this is one that gets a little tricky, any deal they're investing in as well. We have this with a lot of our investors, our passive investors. And if you're both trying to invest in a deal and one of you wants to come in with a retirement account, if that other person is a disqualified person, unfortunately, that's not possible. You cannot invest with cash and with retirement accounts when there are two disqualified people interacting. So who are these disqualified people? Well, we've already mentioned it. You are the first one. You're kind of the central hub here of who you can't work with. But it also applies to any linear ascendants or descendants. So your parents and grandparents are disallowed, anyone in blue here, and your children and your grandchildren. And it also includes spouses at any level. So sons-in-laws and your own spouse, unfortunately. But luckily, I don't know why they chose this, but anyone off to the side, siblings, nieces, nephews, aunts, uncles, and cousins, they're all fine. But unfortunately, a lot of the people that many of us would choose to invest with first and foremost are actually disallowed when using our retirement accounts. So this is pretty restrictive, unfortunately, but there is actually a way we can get around this. So if you recall from a few slides ago, I mentioned that you should think of your retirement account like it's another person. Well, this actually comes back to help us here, because the same concept goes for your disqualified people. Their retirement accounts are different people. They're not disqualified people. They're just their retirement accounts. And so if everybody decides to invest with their retirement accounts, you can actually turn your family tree from this into this, and you can invest with anybody you like, as long as everyone is in the deal or in an investment with their retirement account. And so that's actually what I do with my family. We all put together our retirement accounts in a holding company, and we're able to combine all of our money into one LLC and move on from there. And the nice thing is this actually allows us to diversify more on a personal level. And so what I mean by that is, let's say that an investment minimum in a property is $75,000. My sisters and I, we can actually get in each for $25,000. And, that means that I can put my money in more places. I can diversify across more cities across America, different asset classes, whatever it is that you desire, you can get in at a lower personal level and further diversify your retirement as a result. So if you like little tips and tricks like this, I do have a free PDF. Would be happy to share with anybody who's interested. You can text the word top 10 to 66866, and it's a little quick read. It'll show you all the different little things that aren't really well known that allow you to do little things like this to maximize your overall retirement account. So what kind of accounts can you actually make use of here? There's kind of two flavors here. As I mentioned at the beginning, there are custodian accounts, and then there are also checkbook accounts. So custodians, these are who are going to open the actual retirement account and then hold the money. And so I need to stress that these companies are actually not fiduciaries. They're not required to have your best financial interests in mind, and they never actually do, because they have an entire schedule of fees, and a lot of the times these fees are not cheap. Most companies that advertise very heavily in the space, they actually have the highest fees. There are some custodians that have somewhat low fees, but they're somewhat hard to find sometimes. And so the biggest names actually have quite high fees. They're not required to give you investment advice. And the sad thing is, every time you find an opportunity, an investment, whatever it is, whether it's a single family home or you're investing in a multifamily property or self-storage, you need to apply and for paperwork, and you need to actually get that transaction approved by the custodian. And what we found, at least with my investors, what we do is we will release, a webinar presentation on our offering on, let's say, day one, and then 30 days later or 45, there's the funds due date of when everyone needs to come in with their funds. And we've actually found that a lot of the times our investors they very nearly can't actually invest in that offering, because the paperwork just takes too long, and some custodians just really drag their feet. And so we have to get after the custodian and make sure that they're actually processing it. It doesn't take long to process. It just sits on someone's desk. And so for the pleasure of, having that, entire pain process, done to you, you actually have to pay for it. You have to pay every time there's a transaction. So it's slow, it's expensive. And this is really what I found as an investor when I wanted to deploy multiple retirement accounts between my sisters and myself. I realized this wasn't a viable option. It was just going to be too bulky to operate. We have 7 retirement accounts, and it was just going to be too much. And so I've actually opted now for checkbook control. It's something I heavily advocate for. I don't really get paid to, advocate for it, but it's something that enables the investor to their ultimate ability. And it takes it a step further. You need to start with a custodian account, but you're actually going to, talk with a company that offers these checkbook accounts, or they help set you, help set them up for you. And so you're going to open a custodian account, but you're also going to open up an LLC for your checkbook account. And so the custodian account is going to fund that LLC, and that'll be the main investment that the custodian account makes. And then from that LLC, you can actually open up a bank account just like you would for any other business. It puts you in total control, and it's super fast and cheap. In fact, the fees are actually less expensive. They're typically annually between $125 and $180. It's very low cost. It makes sure that all your returns stay in your checkbook account. And I like to joke, but you can, find a deal at breakfast and fund it by lunch. You just have to apply for a wire and pay the wire fee every time you want any kind of investment. It's the same as any other business. And so there are really two different types of checkbook accounts. There's the self-directed IRA and the solo 401k. And so this is very, very high level. There's some more intricacies between these two, but the main differences here are that the contribution limits are vastly different. Anybody can open up a self-directed IRA, and as a result, the contribution limit it's much lower. This year it's $6,000. If you're over 50 years old, you can contribute an extra $1,000, so make it $7,000. And then the solo 401k, if you're eligible for it, you need to have self-employment income, and if you're eligible for it, you can put in up to $56,000 from the business that is, sponsoring that solo 401k plan. And so, the biggest difference when it comes to, investing in multifamily that I do or any kind of leveraged asset, is the fact that they are actually not subject to taxes. A solo 401k is 100, it maintains that 100% tax-free status of a retirement account. But unfortunately, if you are going to be operating with a self-directed IRA and you invest in a leveraged asset, you are actually subject to taxes. And I'll talk to that in a bit. So just real quick, I want to go over kind of what these accounts look like. Hopefully kind of dispel any kind of confusion in terms of how complicated this might be. So as we see on the left here, there's the self-directed IRA custodian account. You just open up a new self-directed IRA and you transfer in your funds from an old IRA or 401k. As I mentioned, you open up an LLC, someone takes care of that for you, and then the custodian buys 100% of the LLC shares. And from there, you get to manage that LLC. There's a bank account, and all of the expenses and income from your investments flow directly back into the LLC. And a solo 401k is actually even more simple. The flow chart looks a little more complex, but it keeps it even more simple. There's just the solo 401k. There's no LLC. There's no business. You can add that if you'd like, always, but you can contribute to it two different ways. You can do rollovers from previous retirement accounts, or you can contribute to it from your business, as I mentioned, up to $56,000. Or again, if you're over 50 years old, you can actually contribute another, I believe it's $7,000 now. So it's a really nice opportunity to pack a lot into your retirement account. And so from there, directly from the solo 401k, you can make your investments. And as a lot of folks know, you can take distributions, a 401k loan, all of that can go directly to you, but you get to control your investments directly. So how do you fund these accounts? Well, you do so with rollovers. And, the two most common, these aren't two most common, but the two that we need to talk about first are actually Roth IRAs and inherited IRAs. If you have either of these two types of accounts, you're actually locked into these types of accounts, unfortunately. That means you can only open them and roll them over into a self-directed IRA. They're stuck in there. Unfortunately, if this is your case, I sympathize with you. This is my situation. I only have Roth IRAs and inherited IRAs currently. So we'll have to deal with taxes. So, and I'll get to that in a second here. But if you do have a traditional IRA or a 401k or 403b, Roth or traditional formats, those are actually totally free to move. You can move those anywhere you want. whether it's a self-directed IRA, a solo 401k. There's also the EQRP. You can move them all kinds of places. And whether you're eligible now for the solo 401k or you're not, and you just have to move it to a self-directed IRA, they can always bounce around and move between those accounts. So let's talk about those taxes I was mentioning. Let's say we're buying this building. I have the building in the up top in light blue, 25% down payment in equity, and 75% of the property is being purchased with leverage from an outside source, from a lender. So if you're investing in a leveraged asset or multifamily property with your self-directed IRA, the portion of income that comes from your the equity of your self-directed IRA is never taxed. You don't have to worry about that at all. But the portion that is derived from the leverage is actually considered, it's a concept called unrelated debt financed income. Because you're investing with your tax deferred dollars and you've decided to invest in something that's bringing in non-tax deferred dollars that are benefiting your tax deferred dollars, you have to pay taxes on that. There's that portion of money that is being derived just by a bank. It is not your IRA. And so we pay taxes on that. But the nice thing is, because it's outside dollars, those outside dollars can actually make use of their proportional share of depreciation, operating expenses, really any kind of loss or expense on the property. Let's say there's 75% leverage on this property. We're going to get taxed on 75%, but we can actually make use of 75% of those losses in the first year. So, and the ratio changes as you pay down the loan, but the nice thing is you can actually offset a lot of your tax burden. And so I actually went ahead and built a UBIT calculator. A lot of people question how bad is UBIT, and a lot of people say it's terrible. You should never get involved with a UBIT generating investment. So I wanted to go ahead. I have an analytical background. I wanted to go ahead and actually answer that question once and for all. And so I built, it's not the prettiest spreadsheet, but I built a calculator that I provide to all of my investors. And what we've found by running hundreds of properties through the UBIT calculator is that for the most part, those losses we mentioned will actually offset your tax burden in the first 3 to 4 years. So in this example, that on a property we closed on last year, as you can see on, let's see, line 5, that's the actual UBIT obligation. You can see for the first 4 years, there's $0 obligation. In a lower interest rate environment, because there are fewer interest expenses, we've actually found that some properties, on, let's say, if you look on line 3, this is the cash flow that you're going to be seeing. So it kind of hovers around $7,000 to $8,000 to $9,000 annually. On that amount, we're looking at a couple $100, $500-$600 on $9,000 worth of income. So it's pretty minimal. The large tax burden, as you can see, is actually on at sale on a capital gains event. We can see this on line 5 in year 5. And so we see that there is a $29,000, almost $30,000 tax. And so that's a pretty significant tax bill. But luckily, if you take a look at this, and I wanted to illustrate this over the lifetime of the entire asset, if you take a look at it on the bottom in dark gray, the top 3 lines are kind of the before we had to pay taxes, whether it's your solo 401k or you're investing with cash. These are the returns you can expect to see. And illustrated in the bottom right, I've actually shown what the UBIT reduction is on an annualized basis. And so we've actually found that typically most properties actually will have a UBIT reduction of between 4 and 6% every year. And so on this deal, we were expecting to return almost 23% to our investors. And because there's a 6% return, we're still able to return 17% to investors. So, a lot of the times, UBIT is not the big scary monster that a lot of people make it out to be. And there are some types of investments that are perfectly tuned for the retirement investors. There are some that don't really match up. But with this calculator, I've actually been able to hunt down deals specifically for retirement investors. I've had to turn down a lot of deals this year because, they're good looking deals, but unfortunately they just don't match up with, the retirement investor, someone who's going to be using a self-directed IRA. So in a deal like this, it's really nice. As you can see in year 3, we actually have a refinance. I should mention that a refinance is not at all a capital gains event. So if you look at return of member capital, back up top. There's $61,000 being returned of your original investment. And with that, you're never going to get taxed on that. So you actually have a large portion of your original investment being returned to you. You can go out and turn to another opportunity, reinvest that, and really start to compound the growth of your investment, of your overall account balance before you ever have a sale. That's key. I look for a lot of these types of opportunities. Bridge debt is a little difficult right now. That's the kind of loan that allows for this type of transaction. But it's now they're having a bit of a rough patch this year. But hopefully we can find some deals that line up with this concept. But other than that, you do have to pay the tax. And so the question is, how can you get around this tax? So I do have a small trick that'll actually result in a pretty large impact. And the concept surrounds UBIT avoidance. So if you're not self-employed and you can't actually open up a solo 401k right now, and you can only open a self-directed IRA, get started investing with the self-directed IRA. You can invest in whatever you like if it's a leveraged investment, and it's going to generate UBIT in the future. And then somewhere down the line, you can earn self-employment income. You can become eligible for it. And then what you can do is open the solo 401k and then take the investment that's in the self-directed IRA, do an in-kind transfer, and move it into the solo 401k. And as long as it's sitting in the solo 401k at the time of a capital gains event, you're going to avoid UBIT entirely. It doesn't matter if the self-directed IRA was the initial vehicle, if the investment once sat in that self-directed IRA. All that matters really is that you're actually going to be investing or triggering the capital gains event while it's in the solo 401k. So this is a nice concept. What we've learned is it's really important, if you plan on doing this, to do so within one company that offers both the self-directed IRA and the solo 401k option. It's a legal transfer, so you need to make sure that all sides, between the custodian on the self-directed IRA side, the custodian on the solo 401k, and the group that actually owns they hold your investment. You need to make sure all three of those points of contact agree on what you can do. And as long as you have the same custodian or the same company that's setting up both of these accounts, that eliminates a huge problem that some people might have. And if you're moving it from a self-directed IRA to solo 401k, that really simplifies things entirely. It's not terribly impossible, the other method, but it just makes your life a lot easier. So it's something I should mention. Again, if that's one of my little tips and tricks. So if you like those kinds of things, I would love to share some more with you. So feel free to text the word top 10 to 6686, and you'll see some more things that can help you to maximize your account. So that's all I've got for you today. But if anyone's got any questions, I'd be more than happy to help out.
Hey, Josh, it looks like we've got a few questions in the chat box.
Sure. Let me pull that up. Let's see here. Can you invest in old musical instruments? So no, that'd be considered collectibles, unfortunately, as elegant as they are. Yeah. What are some of the recommended custodians to move to? So I primarily work with two different companies because I like checkbook control. I work with one company to open up. We've opened up all of our accounts with them. If I like to kind of split it up between two people or two types of investors. If you've got plans to invest in a whole mess of different things, whether it's different alternative assets, different businesses, different real estate, and you want kind of someone to consult with, to be an advisor to you, I use a company called Safeguard Advisors. They'll help open up the custodian account for you. They're not actually the custodian. They have an exclusive relationship with a custodian. And they also have attorneys on staff who open up the LLC for you and then get everything done for you. And so the nice thing is they will actually provide in perpetuity advisory services. And so if you ever have a question about what you're about to do, and if it's going to be a disqualified transaction or prohibited, you can actually ask them. If you plan on doing one thing, getting good at it, maybe just being a passive investor in storage, multifamily, whatever it is, I like to go with, there's a company called Rocket Dollar. They're a great company. They're purely online. Everything's streamlined, very easy to manage. And the fees are incredibly low for them. To start it up, it's $360. I do have a discount code if anyone's interested. That'll take $50 off of that. And then the monthly fees are like $15. So it keeps it really cheap. But they don't do advisory services. So I like to suggest them for folks who, they know what they want to do, and they kind of just want to put it on, set it and forget it. And they don't really need to figure out every single time they invest if something they do is right or wrong by the IRS. Yes, I'll absolutely share this deck for you with you. If you want to email this email address and just give me your email, I will be happy to share all this with you. So what about lesser known custodians like IRA Services Trust? Yeah, so their fees can be lower. I have found some custodians that have lower fees. A lot of them have different fee structures. So some will, they'll charge by the asset. That's one that I hate, because eventually, I mean, the ideal concept is you're going to own 10, 15 different properties or assets. And if you have to pay $250, $300 for each one, that gets burdensome, very expensive. But all of these custodians, right on their front page, I think it must be a legal requirement, but they all have their fee schedule right there. So you can, some make it a little difficult to find, but somewhere on their page, you can actually dig into it and figure out exactly how much it's going to cost. Some do it by overall asset valuation of the entire account balance. There are some that are lower, there are some that are higher. I just haven't seen any that are as cheap ongoing as checkbook control accounts. Are the funds that are still with the custodian still invested in mutual funds or ETF, or just cash sitting there? So that's, when you do move something into a self-directed IRA, it is pretty important to move it into cash to get it in between custodians. It makes the process a lot simpler. And then there are some custodians that have the ability to actually open up a brokerage account and invest in stocks and bonds while the cash is just sitting there. Some don't, so it's something you should check on every time you open an account. But if you, let's say, you have some distributions coming in from an investment you have, and there's a couple $1,000s trickling into your account, and it's just kind of sitting there, you do have the option sometimes of moving that into something that's a little more liquid, something that you can do in between larger investments, just to make sure that there's always something going on with your account. So that is a possibility. Do you need to reserve a wad of cash in the checkbook account for taxes? So actually, yeah, this is something that took me a while to figure out. So you only pay UBIT taxes through the gains that come into your account. So the nice thing here is you never have to have a wad of cash in the checkbook account. You don't have to have a wad of cash sitting yourself, because you're not allowed to pay the taxes that your IRA is obligated to pay. But the only time you're ever going to pay taxes is when there's actually gains. So they come straight. They don't come as, you can't just, defer them. So you have to have the gains come in and then reserve enough to pay taxes when tax day comes. So that's something that you should definitely plan with your CPA on, because if let's say you trigger a capital gains event and you have UBIT in June, and you go and you invest all the gains, everything that's in your account, you invest it all in July. Well, if it's in an illiquid asset or investment, you actually, when it comes tax day in April, if you don't have any funds to pay the UBIT, you're in trouble. So you need to make sure that you do talk with your CPA, figure out how much you're obligated to pay in UBIT for the year before you go out and invest every dollar of your checkbook account or IRA at all. That's something that can really trip you up. Roth IRA doesn't allow for contributions. What? Do same? Yes. So this is the question on income limits. A self-directed IRA is the same as an IRA or a Roth IRA. It's kind of a naming misnomer. They're really just the same account. They just allow you to kind of control one or invest it in something that you opt for. So they do have the same income restrictions. The nice thing is, because they're just the same as an IRA, there are the same, tricks like the backdoor Roth and the mega backdoor Roth. There are ways to get around this, but yes, Roth IRAs or a self-directed Roth IRA is impacted the same way. A self-directed traditional IRA doesn't have the same It's treated just the way as a traditional IRA would. So it doesn't have an income limit at all. Options for 401k at former employer with 250k plus balance. Oh, sorry, that is private. Apologies. So I won't say who that was. I'll email it back to all these people. And yeah, so Anthony had to hop off. Email accounts for everybody. Cool. Thank you guys. If there are any other questions, I would be more than happy to let me stop sharing my screen here. If anyone else has any questions, I'd be happy to reach out to them or have them reach out to me. I can, I can help you with any individual questions you have if you didn't want to put this in the chat. But yeah, that's all I've got for you. Please reach out. My website, walltomain.com is, I put together kind of a list of different topics. And so I have a little learning center, and in this learning center, I've got different videos I recorded on retirement accounts. I recorded 6 videos. They total 30 minutes. I went over a lot of the stuff in this presentation, but if you go through that video series, I'll give you everything A to Z that you need to know on how you can passively invest with your retirement account. So that's all I've got, but thank you everyone for joining, and thanks to Anthony. I hope his variation goes well on his other call, but thanks everyone. Have a great night.